What's up, guys? It's Mr. Fit to Flourish, and today I wanted to talk about some basic rules about price action and how to read charts for beginners. So a lot of the time when people start trading, the first thing that they're looking at is they're looking at the chart and they're just seeing green and red, and they don't really understand how candlesticks work. And the charts that we use currently in trading in the US and pretty much in the entire world are mostly Japanese candlesticks. Okay, we mostly use Japanese candlestick charts. Now, when we look at candlestick charts, you see these red bars and you see green bars. Some of them are small, some of them are really, really big. And what does it even mean? What does it even mean? Well, let's take a look at it. So to understand how to read these charts, we need to know green means that we're going up and red means that we are going down. Okay, means that we are going down. So I wanted to show a basic image of candlestick charts and what they do. So basically, when you're looking at a green bar, we start here on the left-hand side. So these are called Japanese candlesticks. The middle part is called the body. The top part, the skinny part, and the bottom part, the skinny parts are called wicks. They're tails. And they form what's called a candlestick. Green is telling us that price is moving from low to high, so price is going up. The red is telling us that price is going down. Now, when you trade, you're usually trading in different sessions. So these candlesticks measure units of time, measure trades in any unit of time. So, for example, it'll measure all the trades in a minute if you're looking at the 1 minute time frame, or it'll measure all the trades in a day if you're looking at the daily time frame. So again, the bottom part of this rectangle is where price starts, so it's the open, where price starts in that that time frame. So if it's a 5 minute time frame, this is where price starts, and then at the end of the 5 minutes, price closed here. Now in between that time, so from the 0 to the 5 minute time frame, in between that time, we have a low that was put in during that time frame, and then we have a high. And it's just the opposite for the red bar. So the red bar, in the beginning of the 5 minutes, we will open at the top of the rectangle, and we close at the bottom of the rectangle. And in between that time, again, we put in a high and we put in a low. So one thing you need to understand when it comes to price action or how to read these candlesticks is what's happening with the wicks. So as you can see, I said during this 5 minute time period, we opened here and somehow we pushed up super high to this level. So what's happening when we form a wick? When we're forming a top side wick, it means that price was going up and then it got pushed down because sellers stepped in. So some people, powerful people, started selling this stock down to this level. So sellers are stepping in. Okay, when you see topside wicks, sellers are stepping in. They're pushing price down. Now, when you get a bottom side wick, it means that at some point in that time frame, price was going down, 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 and then all of a sudden, buyers stepped in. So someone's pushing price back up, which is why we don't have a solid part down here. It would have been a solid part if price was still down, but price got pushed back up. Okay, so a key concept to understand. Again, the middle part is called the body. These skinny parts are called wicks. Okay. So let's take a look at that. Let's apply that concept. So in this case, it looked like someone was trying to sell, and then all of a sudden, we had buyers step in. Buyers stepping in. And usually when I see these bottom side wicks, it tells me that, hey, if we get down to this level again, it's probably going to be buyers stepping in. And look, it happened before 1 time, 2 times, and then 3 times. So whenever we got down to this level, if we look at this chart, this level is 451.78. Whenever we got down to this level, buyers stepped in. So someone tried to sell, and then all of a sudden, boom, people started buying price back up. Bottom side wicks show you buyers stepping in, so price is likely to move up. And that's exactly what happened. Now remember what I said about top side wicks. Top side wicks show you that sellers are stepping in. So as we can see here, we have a wick, top side wick, top side wick. So every time someone's trying to buy price up, price rejects. So remember when we fail off of a resistance level, that's a rejection. So we rejected and sellers stepped in, pushing price down. And what happened? Look, big red bar followed because someone kept pushing price down. We are rejecting. We have sellers stepping in. So top side wicks and bottom side wicks are really good indicators, really good signs for future moves when we're reading price action. They're probably the most important part of reading price action. Okay. Now the next major concept that we need to understand when we're reading price action, this concept is trend bars and non-trend bars. Trend bars and non-trend bars. Okay. What is a trend bar? What is a non-trend bar? It's pretty much exactly what it sounds like. Okay. Trend bars are really big bars, big green bars, big green bar, big green bar. So trend bars are bars that contribute to the direction of the trend. So if it's green, then it's probably causing an uptrend. It's probably causing price to go up. So this is an uptrend. An uptrend is a series of higher highs and higher lows. Now a downtrend would look something like this. A lot of red, lower highs and lower lows. Now these are also trend bars too, these red bars, because they're big bars. Trend bars are big bars, and they're contributing to the downward movement of the trend. 1, 2, 3. Now non-trend bars are little bars like these here. This red one, this green one, this red one. So these little bars here do not contribute to any direction. As you can see, when we get these little bars, price just goes sideways. But when we get the big bars, that's showing selling pressure. So big red bars shows a lot of selling pressure. Okay, this is a good word, phrase, concept to understand. Selling pressure is depicted by trend bars, and then by red trend bars, and then buying pressure is depicted by big green bars. So when we're getting in trades, we want to enter after we see a lot of buying pressure. You don't want to enter when you see nothing happening. There's no buying pressure here, no selling pressure. We're just going sideways because these bars are so small that there's no pressure. Okay? But with this green, big green bar, there's upward momentum, upward pressure. With these big red bars, there's downward momentum, downward pressure. Okay? Very, very key concept. We get in after big green bars. And you will win a lot more trades if you get in calls after big green bars and you get in puts after big red bars. But there's more to it. You need more confidence, but this is a pretty good concept to understand as a beginner. You need to understand selling pressure. You need to understand the formation of these bars, and you need to understand wicks. And last but not least, like we said, you need to understand trends. So when we're getting higher highs and higher lows, and if price is going up from the left of your screen to the right, this is an uptrend. That's an uptrend. Okay? But if price is going down on your screen from left to right, that is a downtrend. It's a downtrend. Okay, in downtrends, you want to go short, which means you're selling or you're getting puts if you trade options. And then in an uptrend, you go long. You buy calls. Okay, and again, you want to get in after these big green bars. You don't want to get in after these little ones. Okay. If you got in after this little red bar on puts and you think the price is going to go down, you're cooked. because it's a little red bar, little green bar, but we get in after big green bars because it shows a lot of pressure. Okay, and then again, we see here, huge bottom side wick. What does that mean? That means someone tried to sell, but then buyers stepped in at these levels. And buyers stepping in causes price to go up. Bottom side wicks means buyers are stepping in. And then these top side wicks, let's see if we can have a good example here. These top side wicks show that sellers are stepping in. Okay, sellers stepping in on top side wicks. Buyers stepping in on bottom side wicks. So buying pressure, selling pressure. And then big selling pressure with these big red bars, big buying pressure with these big green bars. So in terms of price action, these concepts are super important. We need to understand what a Japanese candlestick chart is, what the body is, what the wick is, what it means when we have top side wicks, what it means when we have bottom side wicks, and then also what it means for buying pressure to appear. That's big green bars. What it means for selling pressure to appear, big red bars. Okay, these concepts are super key. Hopefully it helps. Non-trend versus trend bars, uptrends, bar sizing, very important concepts. Take this, run with it, and let's get some money. It's Mr. Fit to Flourish. You guys have a good one. Good morning, welcome to the Fit to Flourish podcast. Let's talk wellness, finance,